You're about to retire. You've built the portfolio. Now you want monthly income. But you don't want to hand 30% of it to the IRS as ordinary income. Then you hear someone say there is a smarter alternative, SPYI and QQQI. They are tax-efficient with high dividend yields and monthly cash flow. Sounds perfect, until someone else starts talking about return of capital, and you get confused again. In this video, we'll clear up that confusion and help you invest with confidence. We'll also simulate investing $500,000 to see what really lands in your pocket. As usual, all data comes directly from official fund fact sheets and verified financial sources. Let's open the hood. The real difference between these funds isn't branding, it's structure. In one hand, JEPI and JEPQ generate income using equity-linked notes. The IRS treats that income like salary, fully taxable at your top rate. SPYI and QQQI use something different. It is called Section 1256 Index Options. And here's where it changes everything. Because of a specific rule in the tax code, profits from these contracts follow the 60-40 rule. 60% taxed at long-term capital gains rates, 40% taxed as ordinary income, no matter how long you hold them. So, instead of paying 30% when investing in JEPI and JEPQ, your blended tax drops closer to 21% with SPYI and QQQI. Same income strategy, different tax wiring, and that difference compounds. But wait, you're going to hear this argument. These yields are fake, it's just return of capital. They're paying you with your own money. Sounds scary. But here's the nuance most people skip. There are two types of return of capital. One is destructive. That's when a fund didn't earn enough income, so it literally sells assets to keep the dividend alive. Over time, the share price bleeds lower. That kind of return of capital is a red flag. But that's not what's happening here. SPYI and QQQI generate income through options. And sometimes, option accounting allows part of the payout to be classified as return of capital, even though the strategy itself generated cash flow. It's a tax classification, not a collapse. And here's why that matters. Return of capital is not taxed when you receive it. Instead, it reduces your cost basis. You defer taxes until the day you sell. So instead of paying the IRS today, you push that bill into the future. That's another layer of tax efficiency. This only works if the share price remains stable over time. If the NAV erodes structurally, that's a different story. But in a properly functioning option income fund, constructive return of capital isn't a warning sign. It's a tax tool. And when combined with the Section 1256 advantage, it's part of the reason these funds behave differently inside taxable accounts. Now let's look at what you're actually buying. SPYI is the broad market version of this approach. It holds exactly 511 companies from the S&P 500. But like most index funds, it's top-heavy. Nearly 40% sits in the top 10, mainly Nvidia, Apple, and Microsoft. Instead of writing options on individual stocks, it writes them on the index itself. That's what keeps it inside Section 1256 territory. And here are the core numbers. Inception, 2022. Morningstar rating, 4 stars. Expense ratio, 0.68%. Dividend yield, 11.8% with monthly distributions. 3-year price return CAGR, 2.64%. And if SPYI is the diversified income engine, QQQI turns up the concentration. It applies the same tax-efficient strategy to the Nasdaq 100. Only 106 holdings, almost 49% of the fund, sits in the top 10 positions. This is essentially a bet on big tech volatility, and volatility means richer option premiums. That's why the dividend yield climbs 13.97%, also with monthly distributions. Inception, 2024. Expense ratio, 0.68%. Growth assumptions in simulations with these two ETFs must be conservative. Not more than 5 years, as they are both young. And before we run numbers, there's something important. You might think holding SPYI and QQQI together increases diversification. It doesn't. They share 88 companies, and 50% of their portfolio weight overlaps. Half your capital would sit in the same stocks. Buying both doesn't hedge risk, it doubles down. By the way, it is always an honor to have you as a subscriber. And now, let's test the strategy the way it actually matters, after tax. Here's the part most investors skip. They compare dividend yields and expense ratios, but they never compare what actually lands in their bank account. So we're modeling a $500,000 taxable retirement portfolio. The key input? Taxes. JEPI and JEPQ income. 30% tax rate. SPYI and QQQI income. Blended 21% under Section 1256. That 9% difference is a head start before compounding even begins. Let's look at year 1. SPYI generates roughly $4,094 per month after tax. JEPI comes in closer to $2,500. That's a $1,600 monthly difference. Not from higher yield, from tax structure. Now extend that 5 years forward, assuming dividends reinvestment. SPYI monthly income climbs to $5,670, compared to JEPI, $3,080. Tax efficiency alone changes the income curve. Now the Nasdaq version. QQQI starts at about $4,883 per month after tax. JEPQ delivers around $3,370. That's another $1,500 monthly gap. By year 5, QQQI monthly income approaches $6,994, compared to JEPQ, $4,356. Higher volatility plus tax efficiency accelerates the compounding effect. But here's the real lesson. This isn't about which ETF is better, it's about where you hold it. In a taxable brokerage account, SPYI and QQQI have a structural advantage. You keep more of your income. Inside an IRA, the tax shield disappears. Now expense ratios matter more, and the gap is tightened. JEPI and JEPQ charge 0.35%. SPYI and QQQI charge 0.68%. So, by removing taxes from the equation, lower expense ratios may tilt the balance back. Now, if you want a full deep dive on JEPI versus JEPQ alone, check out the dedicated video linked here. And as always, run your own numbers before making the switch. Thank you for watching.